The late 1990s introduced a generation to the World Wide Web, launching an era defined by rapid technological shifts and intense market optimism. Take the 1999 initial public offering of eToys. Despite having only $30 million in sales and deep negative profits, the market valued the young startup at $8 billion. Compare that to Toys R Us, the dominant player in the traditional retail market at the time. This chart illustrates the glaring math problem. Toys R Us generated $11 billion in revenue, towering over eToys. Yet, when adding market valuation, the unprofitable startup inexplicably skyrockets $2 billion higher than the legacy giant. This inverse relationship makes zero sense. The arrival of the World Wide Web had induced a collective market delusion, suspending foundational business math in favor of digital hype. This diagram shows how macroeconomic fuel fed the fire. A combination of low Federal Reserve interest rates and an overflow of eager venture capital created a massive funnel of cash dumping straight into the tech sector. Unlike obscure advances in shipbuilding or material science, the web was something individuals used directly. This constant personal interaction made it easy to imagine a future where the technology dictated all economic value. This environment birthed a flawed foundational philosophy: the get big fast strategy. The goal: capture market share, amass user eyeballs, and build brand awareness aggressively, completely abandoning near-term profitability. The fear of missing out effectively replaced due diligence. Investors felt forced to throw money at broken business models just to stay in the game. Instead of building sustainable products, the industry shifted its focus to buying expensive attention. Startups rapidly burned through their investor cash on massive promotional campaigns. The peak of this frenzy arrived at the 2000 Super Bowl, where 17 different dot-com companies spent millions of dollars of investor capital to air television commercials. Pets.com became the ultimate poster child for this era. They poured fortunes into national marketing, entirely ignoring the cracks in their business model. Their logistical system was so incredibly expensive that they literally lost money on every bag of dog food they shipped. This is called negative unit economics, where the cost to deliver a single product is higher than the price the customer pays. It was the rot at the core of the bubble. This creates a fatal paradox. When your unit economics are negative, aggressive marketing and rapid customer growth don't build a business. They actually accelerate your path to bankruptcy. Burning cash on vanity metrics like brand awareness without a profitable way to actually fulfill those orders is a guaranteed speed run to liquidation. We see this clearly with Webvan, perhaps the era's most ambitious operational disaster. Armed with $800 million, they set out to revolutionize online grocery delivery. They committed the fatal error of premature scaling. Before proving their model worked in a single market, they expanded to 26 cities and built highly automated $30 million warehouses. We can see their broken math here. Their customer acquisition cost, the amount spent to acquire a single buyer, exceeded $100. Compare that to their customer lifetime value, the total revenue expected over time. That averaged less than $80. Webvan proved that no amount of advanced technology or massive venture funding can fix a business model where you spend more to acquire a customer than they will ever pay you back. The turning point arrived in the spring of 2000. Interest rates rose, and the endless flow of easy capital abruptly dried up. The immediate consequence was a total reversal in sentiment. Investors stopped funding operating losses and began demanding actual profits. What followed was a mass extinction event. Companies with massive cash burn and zero revenue died almost overnight. The tech-heavy NASDAQ index collapsed as tech, media, and telecom stocks were dumped in a wave of global panic. The ultimate financial toll was staggering. The NASDAQ plunged nearly 80% from its peak, evaporating $5 trillion in market value. A market built entirely on speculative hype, rather than durable cash flow, will violently correct the moment the supply of new capital stops. Curious, hopeful tone. Amid the wreckage, a few companies survived. Names like Amazon and Priceline managed to weather the storm. While using the trendy .com name, these companies maintained solid operational cores and eventually adapted their models to reach actual profitability. These survivors showed that the internet could significantly enhance fundamental economics, but it could not replace the need for a profitable core business. Survival during a market crash relies entirely on capital preservation and underlying business mechanics, not on the prevailing industry narrative. We are seeing patterns reminiscent of the late 90s today. NVIDIA's share price recently climbed roughly 4,300% in 5 years, mirroring the 4,500% ascent Cisco saw leading up to the 2000 peak. Much like adding .com to a company name in 1999, casually slapping AI onto a pitch deck today has become a common tactic to attract speculative capital. The timeless law of business remains unchanged. Validating product-market fit and achieving sustainable unit economics must always precede scaling. Hype can never outrun bad math. Don't let your business fall victim to the hype cycle. Build sustainable growth systems and smarter marketing strategies with the professional guidance of